Hello again, everybody. Dr. Richard Smith here with Cycles TV and the Foundation for the Study of Cycles. Good to be with you all again. And things are getting interesting. So I've been looking at inflation and unemployment and equities for the last few weeks. And we're going to look at it one more time today because I think it's really about as good a setup as we can find. So I'm going to get into that in just a minute. Happy to take some of your reader's choice questions as we move through. But I think it's cycles are really clearing up here. And things have been breaking our way, I would say. So let's dive in and take a look. All right. So let's get the screen sharing going. So here we are today, Tuesday, July the 15th. And we had CPI come out today for June. And we will look at it again today. But a month ago, we looked at the cycles in CPI and in PPI, which comes out Thursday, unemployment. And today we got a actual core CPI of 0.2 instead of the forecasted 0.3. So that was a upside surprise, or in the positive sense, right? So less inflation in the core CPI than was expected. That led to a rally right away in equities and even in treasuries, which has not followed through yet. The full CPI was on the nose, 0.3 versus 0.3. Both of those were up a little bit from the previous month, and the actual year over year was 2.7% versus 2.6%. So a slight tick up from what was forecasted. So on the whole, pretty spot on, I would say. This is the interpretation from the Wall Street Journal. We can see core ticking up a little bit and overall ticking up a little bit, certainly not continuing down. So you can basically read into this whatever you want, but not declining. And in fact, prices of households, goods, video and audio products, toys and apparel increased, right? While new car prices decreased in June. And we're still not clear yet what the final policies are going to be around tariffs. So that uncertainty is still dragging on outlooks. But on the whole, this lines up well with our cycles forecast, which we'll look at again, that inflation, CPI in particular, is bottoming. In fact, let's just jump over to that right now. So I'm going here to my private or my personal data sets where I uploaded data from Fred. And here's the full CPI data going back to 1955, 850 bars. We could add all the data in there, but that's a pretty good slice so far, I'd say. So we've got this 294, but in particular, and this is monthly data, right? So here's the 64-month cycle that we've been following on CPI and adding in the cyclic RSI here. Let me expand that for you. There we go. All right, so last time we looked at this, I guess we were back here with May, and indeed we got an uptick coming out of the bottom of this cycle. I wouldn't say it's ready to rocket yet, but clearly we have concerns about higher CPI in the future. And I would say this report that came out today was spot on for the cycles hypothesis that we should see higher CPI in the months to come. Related to that, actually, that's not what I wanted to look at. Here it is. This is 2-year treasuries. We see this big 191-day cycle, right? Very clear on the spectrum and suggesting that rates, 2-year rates, okay, as prices decline in 2-year treasuries, that would mean rates on the 2-year going up. And we know that the 2-year tracks the Fed funds rate, kind of is a leading indicator of the Fed's funds rate. So this does not bode well for the Fed jumping in and cutting rates. They might. There's a lot of political pressure on them. But overall, from a cycles perspective, the CPI and the 2-year treasuries are not supporting the idea of rate cuts. If we do get the rate cuts, I'd be selling them short. So that's kind of the picture on inflation. And inflation is a very important element of what we're going to see in the future for the markets. Okay. Similarly, we also got an update on unemployment. I think that was last week. New unemployment filings decreased, right? So it was a little, again, like we didn't see unemployment rising yet, but continuing claims reached 1.97 million, the highest since November 2021, indicating difficulty in finding new jobs. And if we go back to our sources here, there were a couple of things. I think this is the unemployment rate here. Kind of a terrible spike in unemployment there that's clouding the data. But we have this 67-month cycle, which doesn't show a lot of relief and shows increasing, or a lot of potential relief, shows increasing pressure, upward pressure on unemployment. So we did get a report that said unemployment filings decreased, but when we look a little deeper into the data, we're seeing things like continuing claims rising. So we see in the internals of the reports and inflation and unemployment that yes, things haven't taken off, but the pressure is to the upside for both inflation and employment, and that certainly lines up with cycles. All right, so let's now move and look at some shorter term cycles in equities in this case. Give me just a second here. So this is the S&P 500 futures. Gonna make this bigger here. But before I do, just showing you, I've chosen the 174, which is the #1 cycle from a stability perspective, and the 82, which is the #1 cycle in terms of ranking and has good stability and strength as well. And those two are in the ballpark of a 1-2 harmonic. So last week, let me zoom in on this for you. We were right here, okay? And we got not a new high in momentum. We haven't gotten the CRSI sell trigger yet. So if we zoom in on this even more, right? Okay, we can see here is the red line is still above the blue line. So at least as far as the futures are concerned, we have not gotten that trigger yet. But today, at the moment, momentum is looking weak, and we could get that trigger today. We'll see where markets end up today. But, you know, they had a pretty big bounce after the inflation data came out, but that has been given back so far, especially on the S&P 500, the Russell and the Dow. NASDAQ's holding up a little better, but on the whole, the setup is even better than it was a week ago, and I think we're on the verge of getting the trigger. And given that we're going to likely see inflation and unemployment rising over the next few months, we'll look at the geomagnetic data too. Things are shaping up for a very interesting short opportunity. Here's the NASDAQ. Last week, of course, we looked at the declining momentum. Got it continuing here, new highs with declining momentum. Got a couple of good cycles here, the 120 and 182, even the 310 looking out a little further. If we take that 310 off, you know, the picture gets a little more dire in the short term from the cycle. So let's make this a little bigger. Drill down, zoom in here, and we can see, again, the red line just kind of skirting that blue line at the top, but we'll see where the NASDAQ closes today. I think there's a good chance we can get a cyclic RSI sell signal. We'd have to see a big up move in equities over the next, 24 hours, 48 hours in order to not get that sell signal. And if we see a big down move, I'm getting very interested. All right. What else do I have here for you? Here's the geomagnetic data. Of course, we've got this 78 and 181 cycle here. Even this 48, we could add it in. So we've seen, this is where we were last week. We've got another week of data that is lining up nicely with the cycles forecast for a peak into October, end of October. And we know as the geomagnetic data gets more active, then we tend to see prices decline. And we got a very clear signal this week from momentum picking up in the geomagnetic data And so we can expect a little more dis-ease amongst the public through the summer into late October. Another reason that if we look at the longer term data here compared to the S&P 500, okay, this is the S&P 500 here in blue, right? And we see last time we got a bottom in the geomagnetic data. Yeah, we got a little bit more. We got a little new high there. I don't know, what was that? About a week later, 2 weeks later. But then we got this. Okay, that was February 19th was the high in the S&P 500, bottoming just about when the geomagnetic data topped. So here we are again. It's bottomed, and I'd say we're about 10 days into that bottom. So another reason that I think there's a short-term, 1 to 3 month shorting opportunity in equities. Additionally, and this is all stuff that I went over last week, but it's just even clearer this week. Okay, we have the dollar, US dollar, strengthening. And over the past week, it strengthened some more. And today, you're not seeing it on this chart, but today it is strengthening significantly. Very significantly. In fact, let me see here if I can go in and look at some short-term data. Intraday data on the dollar. So many data series in here. Right, it's not in the data, it's in the streams. Okay, so intraday data on the dollar. Let's just look at the hourly data. Is it current 611? Nope. Okay. Sorry, I can't show you that right now, but the dollar is up sharply today. So take my word for it. This signal in the dollar is strengthening. Okay. And we're getting good momentum up today in the dollar. So this is going to be even stronger. And, you know, a stronger dollar is a headwind for equity prices. Similarly, the euro, which we looked at last week, also falling sharply today. This is daily data on the euro. Got strong cycles, and I suspect we will be getting a trigger on the euro sell signal today, because at the end of the day, because it's been a sharp down move in the euro so far today. All right, we looked at treasuries, 2-year treasuries, not suggesting a lot of upside for rate reductions, right? More like down prices mean higher rates. We'll see, but that's what the picture looks like so far. All right, so now just want to go look at some shorter term cycles in the E-mini S&P futures. This is 4-hour data. We looked at this last week, and I think we were July 8th about here, right? So we've gotten prices a little higher, but momentum has continued to decline. So this has been a weak move, and we definitely have a cyclic RSI sell signal on the shorter term data. Similarly on the NASDAQ, so prices have moved up slightly, but momentum hasn't moved up. And we got a little more time on these shorter term cycles before they bottom. So let me stop there for a minute. To summarize, cycles are pretty clear from the 64, 65-month cycle and CPI and unemployment that we should expect upward pressure in CPI and unemployment throughout the rest of the year. That does not bode well for rate cuts to the rescue. In spite of President Trump's pressures and political pressures, we see two-year treasuries with the cycles indicating clear pressure downward, which means rates not going lower. We see equities with deteriorating momentum, huge negative momentum divergence, and cycles clearly topping. We see the geomagnetic data bottoming, which means set to rise over the next 90 days. Those geomagnetic disturbances stir up our feelings of dis-ease and ultimately make us a little more pessimistic over the next few months. Of course, we're in the summer doldrums, right? We know that seasonally there tends to be a bottom in October. And there's still a lot of uncertainty out there in spite of the rally off the April lows, right? But that rally, which coincided with the top in the geomagnetic data, is now run its course. And something really would have to surprise to the upside here for there to be a strong rally over the next few months. So that's what I'm seeing. And sure, Juice Box Boy, we can look at the 10-year and 30-year rates. Good question. A little, those are longer term indicators. I really like the 2-year because, as Sherman and Tom McClellan, great friends of the foundation, have pointed out often, that the 2-year tends to lead the Fed funds rate. So you'd really want to see that 2-year treasury prices rising, which would mean rates declining. And we're not seeing that from the cycles or the momentum or price right now. Hope, love the geomagnetic data. So do I. Will you guys do another video on NVIDIA? Still hitting new highs. I think next week I'm going to do more specific stock analysis. Going to do some scanning this week to look for good stock setups. So we could look at individual stocks next week. So if you have some individual stocks that you'd like us to look at, certainly please drop us a note, put it in the chat here, and you can send an email to memberservices@cycles.org. Let us know what you'd like to look at. But yeah, I'm interested in stocks and looking at a little longer time horizon. And I think we'll dig into that next week. But I just wanted to kind of finish out this analysis that we've been doing for the past month, looking at these fundamental indicators, right, of inflation and unemployment, and seeing how clear the cycles are in those things and where we are in the cycle. Along with the geomagnetic data, I mean, it's a perfect setup, okay? Then we have equities also on the daily cycles showing declining momentum and cycle tops. So I like this setup to the short side for a shorter term 1 to 3 month trade. Let's see. All right, so we can go look at some longer term rates. Bill Arndt, thanks for joining us. Monthly charts for USD, 10-year and 30-year on Slack, testing 380-month, 40-year EMA. So Bill's talking about our work in the Market Masters Working Group, where we have a bunch of incredible cycle minds who get together a couple times a month. If you're interested in joining the Master Working Group, please reach out to us. Let us know. It's something that is very selective, but we'd be happy to hear from you if you'd be interested in joining. So thanks, Bill. We'll take a look at those. I know my views are lining up with your views. And for those of you who don't know, Bill Arndt, market veteran, floor trader, known tons of floor traders in the futures markets, incredible market historian. So we're very happy to have him as part of the Masters Working Group. And thanks for your comments as always, Bill. Franz, which assets are highly influenced by geomagnetic and which less? So far, the one that I know is equities. So it's a good question, Franz. I don't have a ready answer for you right now, but I'll think about that this week and do a little research. Elliot, Mag 7, very interesting. They're dominating the market. Yeah, I mean, remember the U.S. exceptionalism is over story from the end of February to April. Unbelievable how these narratives work. Meanwhile, Mag 7 is at it again. NVIDIA, all-time highs, $4 trillion market cap. Come on, people. Think the cycles might have anything to do with it? Yeah, we can take a look at Bitcoin, sure. Some time ago, you presented your examination regarding the persistence of cycles over the past. The new stability score is something different, isn't it? The new stability score is definitely related to cycle persistence. So it really looks at persistence. It looks at also phase and amplitude. So it really is a whole package of persistence over time, lining up of phases and amplitude. So the strength of the cycle. So stability is our one-stop shop for this is the best cycle we can find that matches up on all those three criteria of persistence, phase, and amplitude. So we're really excited about the stability score. It's something you only get at the Foundation for the Study of Cycles, only through our software. So definitely something that I hope you'll explore. And yes, there is just simple persistence. I do still look at that, but the stability score is the best total package that we have for cycle analysis right now. Bill, thank you for being part of the Foundation and part of the Masters Working Group. We love having you. Next week, any sectors that are changing direction? Yeah, great point, Rowan. I'd like to look at sectors along with individual stocks. I'm really interested in starting to drill down into the markets a little bit more, especially with this setup that we have right now. But on follow-up, but only in the analyzed duration, but not further on in the past. Well, you can expand the analysis and add more data to your analysis and see how that stability holds up over time. Especially for longer term cycles, when I see a cycle around 250 or 300 periods, I usually add at least 3 to 4 times the length of that cycle to see the stability, because stability is really looking at the last 3 iterations of the cycle. So good point, Dan D. Cycle convergence appears to have come in on the 30-week and 210 days today. I'm tempted to call a top today. I don't usually do that, but man, if I were going to call a top, it would be today, or maybe by Thursday. Maybe the PPI data comes out on Thursday, because we know the PPI leads in the cycles a little more than the CPI. In fact, we can take a quick look at that when we pull back up some charts. But yeah, Bill, there's a lot of confluence right now in the cycles suggesting that this rally has run its course. We'll see how much of a correction. Could just be sideways for a while. And of course, you know, President Trump definitely loves his bully pulpit. And I don't know if you guys saw last week in the copper markets. I mean, just a passing comment in the Oval Office during a news conference, and all of a sudden copper prices shoot up 20% in minutes. If you were in the futures markets short one copper contract, you got crushed. So there is some unprecedented volatility risk in this market right now with the way President Trump is running his policy and using his bully pulpit however he sees fit. Does create risk and require, I'd say, a lot more vigilance in terms of making sure that, you know, we don't get caught on the wrong side of one of those off the cuff comments. The market has become a little more resistant to them, but that copper move last week was terrifying if you were short and ecstatic if you were long, okay? But it was unprecedented. Copper moving 20% in a matter of minutes is not okay if you're in the futures markets, okay? It's just too much volatility with leverage, so be careful. All right. Bill, we have topped in July in 24 and 23. Yep. Chris McDonald, I'll call it for you. Top. Thanks, Chris. I'm a probability guy, okay? I know there's no such thing as an absolute. Call me a coward. But waiting for that CRSI to trigger, okay? So be careful. All right, let's go back and finish up looking at a few charts. Here's Bitcoin. This is the daily data on Bitcoin futures, BTC equals F. Looks a lot like equities, big negative momentum divergence going back quite a while, right? All the way back beginning of 2024 on the daily data. But momentum is moving up at the moment, okay? And cycles have defied the downward, price has defied the downward pressure of the cycles, right? So if I unlock this and dig a little deeper here, we can see we had this little bounce in the cycles right here. Guessing that was the 138 cycle here. So that's this one right here on the spectrum. But that has run its course now, right? And we're not really seeing new highs in momentum, right? We got the negative momentum divergence. If we just look at the 233, that one's bottoming right now. And that is the most stable cycle at a 70. We've got 850 data points here, so that's over 3 iterations. We could add a little more data and see if that cycle holds up, just to continue to educate ourselves about how we use the software. So I just added 200 bars, and yeah, where was that? So going back to 850 bars here. Refresh. We saw that 233. So when I go out to 1,050 bars, that 233 loses some of its luster, right? We can still see it actually gone. So here's the 200-day cycle that Lars has talked about a lot. When you go out a little further, that one shows more stability. Of course, we still got this 135, 160. So these are positive, but these two, the 135 and the 274, are negative. We add them all together. Momentum is on the side of Bitcoin in the short run, but the cycle's definitely looking toppy and negative momentum divergence. So I'm not short Bitcoin right now, but I am interested in getting short Bitcoin in the next weeks and maybe month to come. Gold, by the way, we've known for a while. Cycle's topping. Okay. I did do 1,050 bars here to get a little more history for this 282 period cycle, but the stability on this thing is very high. Of course, top to bottom hasn't really produced a lot of price declines here. Okay. But momentum definitely down and cycles looking toppy. Silver showing a little bit of room to run. And thought we'd just take a look. I know I'm jumping around here, but this is the yield curve. Hopefully you've been watching for a while. You know what these things mean. We've been talking about it for a year now. So here was the yield curve here's the yield curve as of July 14th. Okay. And here's what it was 3 months ago, this red one here on April 15th. So overall, yields are up, okay, across the board, right? So 1-year yields are up, 2-year yields are up, 5 years kind of about equal, but longer term yields are up too. So President Trump wants these yields to come down so that the US government pays less on its debt. But so far, the markets are raising yields. So not convinced that the US debt is a better bet than it was 3 months ago at the April 15th bottom. So that's where we're at on interest rates. And if we look at cycles, let me just, so there's 10 years. I'd probably add a little more data here just to, especially with that longer 294 period cycle. Yeah, it stretches out some more now, 339. So let's go back to 850 points here. I'll stick with these shorter term, 187, right? Also looking toppy here, just like we saw in the 2 years. So this does not bode well for our yield curve coming down, right? So this is looking like yield curve higher in terms of the 2 years and the 10 years. And then lastly, we'll look at the 30 years here. Again, this 191 here is probably the one that interests me the most right now. And again, declining, deteriorating momentum and cycles nearing a top across the yield curve spectrum. So it doesn't look to me like rates are going down. Looks like prices are going down and rates are going up across the spectrum, which means that, more pressure on US debt. Not clear exactly what it means for the stock market. Yields can go up and stocks can go up, right? But the idea that Powell's going to come to the rescue with rate cuts is what I'm calling into question. That's the kind of catalyst that I think could really move the markets to the upside. And I'm not seeing it. That's basically my point here of looking at rates not declining. We've got CPI bottoming, potentially headed up. We got the one big beautiful bill passed, which is going to increase the deficit. Maybe we'll grow out of it, right? But that growth is going to take a while to manifest. There are some good things in there. I'm not unduly criticizing it. I'm just saying the risk to inflation is to the upside. Makes it harder for the Fed to lower rates, and makes it easier for equities to not soar from here and potentially decline substantially. So I think there's a low risk bet. That we can keep a tight stop on, see if we get a correction into October. And next week, I'll dig into some sectors and equities more specifically and see what we're seeing in the more internals of the markets. So I think that's good for today, gang. Throwing a lot at you, but it looks like you're keeping up. So appreciate it. And give us a like, tell a friend, upgrade your membership, support our work. And we really appreciate you joining us. And I'll see you again next week. Lars is on holiday, so it's just me. But look forward to seeing you next week, and Lars should be back the week after that. So have a great week, everyone. Be careful, but things look toppy in equities. See you next week.